It's my pleasure to show you guys what I think about the Schedule C. And the Schedule C actually brings everything together. We talked a little bit earlier with JT, the W-4 form, and he brought back that extra money back into your household. And you know, when you get some extra money, the first thing you're going to do, you're going to think about it just a little bit, what you're going to do with this extra money. Okay. And as a myEcon associate, when you show somebody how to bring back that extra money into their paycheck, you are going to offer them a business. They can take a portion of that money, start their business or start a business. But for less than $100, you can start a myEcon business. But the Schedule C does not only go for myEcon. It's any business. Any business that you start, you are entitled to 475 tax deductions. And if you see that, it says for businesses and self-employed individuals. It doesn't say anything about an employee. Okay, you're entitled to these deductions when you own a business and you have the capability of using a Schedule C. Okay. Stephanie talked about the cash flow strategies. You're going to think about what you're going to do with that money. So lay that out, what you're going to do. Taylor talked about the cash flow manager. Cash flow manager gives you a way to keep track of the money spent all during the year. But at the end of the year, when you file your taxes, and it comes once a year, every year you're going to file your taxes, having a Schedule C will put you in a whole different category. Okay? Now, a couple of things you need to understand about your taxes. You report your ordinary income on a Form 1040. Everybody knows about a Form 1040. But you report your business income or loss, you see that in parentheses, on a Schedule C. And the name of the game is to pay as little taxes legally possible on your income at the end of the year. Pay as little tax as you possibly can. So you're going to try to bring down your taxable income. Okay? Now, like I said, the first part was JT going over the W-4. Then we did the minimized taxes by way of the cash flow manager. Okay, so now this will all bring it all together. Okay, like I said, we did using the cash flow manager to keep your records together. Okay, but now we're going to talk about 3 different scenarios. Okay, and we're going to talk about a household that's got $75,000 from a job, but they got $20,000 in expenses. You're all going to have expenses, you know, your cable TV, your electricity, gas, water. It adds up, you know, $20,000 worth of expenses. And we're going to talk about someone without a business. Then we're going to talk about someone who started their business, but they only made $5,000 during the year. They got $20,000 in expenses, but they made $5,000. And then last but not least, we're going to talk about somebody that made $40,000 in their business, in addition to the gross income of 75. Okay, so let's take a look at these 3 different scenarios. Okay, as I said, all your income is reported on the 1040. The 1040 is a 2-page document. You know, you got the front page and this is the back page. This year, there are 3 schedules that are attached to the 1040, Schedule 1, 2, and 3. But we're going to work with the Schedule 1 because Schedule 1 is something that you're going to have to know. Okay, you got your Schedule C on the left-hand side, and you got your Schedule 1 where you show the additional income that you received and adjustments to your income. Okay, so let's just take a look at this together. Okay, your Schedule C is where you report your profit or loss from your business. Okay, part one is the income that you've incurred from your business, and part two is the expenses that you have incurred from your business. Okay. And again, we're going to look at the 450 tax deduction. Okay, here's the Schedule 1 that's a part of the Schedule C. Now you see it seems a little confusing because you're talking about different schedules and things, but just follow along. It's really not that difficult. Again, like I said, we're going to talk about an employee that made $75,000. They got $20,000 in expenses. The employee made $75,000 on their job, $5,000 in their business, got $80,000. Same $20,000 worth of expenses. And then the employee would have made $75,000, but made $40,000 in their business. Now you see the difference in the income, but down at the bottom is your taxable income. That's the one that you want to reduce. And we're going to figure out what will happen in each of these different scenarios. Either you don't have a business or you do. Okay? So we're going to talk about those three different taxable incomes that you're going to try and work down to. We're going to work on the 1040. First scenario, you fill out the top of the form just like normal, where you put your Social Security number in and your dependents. But we're going to really mainly be concerned about this lower portion, which is where you report your income on your 1040. Okay? So the person without a business, we're going to talk about someone without a home-based business first. This is how they'll fill out their tax form. They made $75,000 in wages and salary. Okay? They don't have any tax-exempt interest, no qualified dividends, no IRA pensions or IRA distributions or pensions and annuities. Okay, no capital gain, no other income. So on line 9, it says add up lines 1 through 7 and 8, and this is your total income. They made $75,000 on the job, bring down $75,000 there. Okay, the next line says Schedule 1, line 22. You don't have that, okay, because they're not business owners. So when you add up lines 10A and B, you're going to come up with a 0 right there. It says subtract line 10C from line 9. This is your adjusted gross income, $75,000 still. As JT talked about a little bit earlier, your standard deduction is listed on the left-hand side here. We're working with a married couple filing joint. There's a deduction or the standard deduction of $24,800. So if that's a standard deduction, you bring that over on line 12. There are no qualified business deductions. Next line says add lines 12 and 13. Okay, so your income was just reduced by $24,800 just from the standard deduction. Okay, so now your taxable income, line 15, is $50,200. Okay, so let's take that and just put that inside the chart here. Okay, they made $75,000. They could not deduct their expenses because they are employees. Your taxable income is $50,200. So right there in column 1, we put that taxable income of $50,200. Next scenario, we're going to talk about the employee that happened to join your business, that actually got out there and made $5,000 in their business. Now, I'm going to show the $15,000 loss, but you need to think about that. Showing a loss on your taxes is not a bad thing at all. Okay? Yes, you are showing a loss on your taxes, but your expenses did not change. You still have $20,000 in expenses. car, truck expense, your depreciation, interest, travel. Those are your expenses, same one. Okay. Being that you're in my econ, you know that you're now getting was 56 cents a mile for each mile that you've driven while you're conducting business. It's not the miles that you've driven from your home place to your workplace. But when you decide that you're going to have another business and you have to go somewhere there, those miles are tax deductible. Okay, you got 50% off on your communication. Okay, your communication includes your cell phone. That's your cell phone bill. But nowadays, your Zoom is communication. That means Wi-Fi. That means your computer. You get 50% off on communication. If you travel in your business, you can write off the expenses that you've incurred while you're traveling in your business, and that includes airfare, bus fare, parking, tolls, anything that you've incurred, any expense that you've incurred while conducting business is now tax deductible. Okay, meals are tax deductible. Entertainment, not so much anymore. And nowadays, you can pay each child up to $12,500 per child if you hire that child to work in your business. Okay? If you hire someone to work in your business, that's money that's spent while you're attempting to make a profit in your business. It doesn't matter if it's your child or someone else, but we like to tell people about their children because they don't have to pay taxes on the money that you pay them. It's an awesome thing when you own a business. So let's get down and show you what the Schedule C, break down what the Schedule C and the Schedule 1 does together. Okay, again, we're going to work with the bottom half showing the expenses or the income on your job. We're going to have the Schedule C, and we're going to work with Part 1 and Part 2 of the Schedule C. Okay, so let's just show you here. Move this out of the way. Okay, Part 1 is your income. You've made $5,000 in your income in your business. Okay, you just follow the lines, bring down your gross income of $5,000 on line 7. Okay, because you're not going to take anything out. We don't have any cost of goods sold, so you don't worry about that. Okay, your expenses. This is how we show that $20,000 worth of expenses. In here, in this example, we're using $8,000 as the car and truck expenses. At 56 cents a mile, I can promise you $8,000 is not hard to get. Well, in my case, it's not because I have a business that I had required use of my vehicle. Okay, you got deductions in there. Okay, some of your things that you're going to purchase in your business, including your computer or your printers or things like that, they have a 7-year life. Okay, you can depreciate a portion of whatever you spend every year until you recover the amount of money that you spent for that particular thing. Okay, then we have interest that you may pay. There's $2,000 worth of interest. We're showing $2,000 worth of travel expense, $1,000 in meals, a portion of your utility. When you're a business owner, you can take that off. Okay, say you spent $5,000 in wages, that'll give you your $20,000 in expenses. But now remember, you only made $5,000 for that year, but you got $20,000 worth of expenses. Okay, on line 29 is where you show your loss in your business. Bring that down to line 31, but now you have to start reading, and you should always read everything that's on your tax form, every line. Okay, It says, if a loss, you must go to line 32. Okay, so let me bring up line 32 where you can see it a little bit better. It says, if you have a loss, check the box that describes your investment for this activity. Since all of your investment is at risk, check off line 32A, because all of your investment is at risk. So you put that on line 32A. Okay, here, I think I skipped no, I didn't. I was working on this week and I may have changed things around. Okay, now you got to bring on Schedule 1. Okay, on Schedule 1, Part 1, this is the additional income that you're going to have from your business. Line 3, business income or loss. That's that minus $15,000. Okay, we're going to bring that down to line 9. It says combine lines 1 through 8, enter here, and on Form 1040, line 8. So it's telling you, go to your 1040 form, line 8, and put that minus $15,000. Okay, now we're going to make adjustments to our income. If you're following my Econ's lesson, okay, and you're in the Too Smart Evolution group already, you have heard that you need to do something with your money. Take that $5,000 and open up an IRA plan, a self-employed pension plan. Okay, you're going to take that $5,000 and put that into that IRA or retirement plan, and then you're going to bring it down. I'll move that. Then you're going to bring it down to line 22. Okay, it says these are your adjustments to your income. So line 22, you're going to have $5,000 there too. Okay, this is just a holding position or a holding paper for when you go back to your 1040 form. When you go back to your 1040 and you start to fill out your 1040 for the year, and remember you're a home-based business owner now that made $5,000, this whole thing is going to change. You're still going to make the $75,000 from your job. But then on line 8, it says other income from Schedule 1, line 9. Okay, so you go back to that Schedule 1, and if you notice right here, I need to highlight a little bit more, but this is part of Schedule 1, line 9. There's your $15,000 loss. Okay, you bring your $15,000 loss on line 8, like it said. Okay, then you have the adjustments to your income from Schedule 1, line 22. Oh, I'm sorry. I back up one line. Okay, once you put that minus $15,000 there, you just subtract the $15,000 from the 75. Okay, and that's going to give you your total income. Okay, now you have your adjustment from Schedule 1, line 22. Okay, going back to Schedule 1, there's line 22. There's your $5,000 that you put on line 10A. Okay, you add up lines 10A and 10B, you bring your $5,000 to line 10C, and it says subtract line 10C from line 9. This is your adjusted gross income. You got a $55,000 adjusted gross income. In addition to that, you can do your standard deduction of $24,800 that you subtract from the $55,000. And on line 14, I'm sorry. Please, I hope you follow me. I put this standard deduction on line 12. There were no qualified business deductions. So on line 13, you put the 0 there. So you add up lines 12 and 14. Okay, so that's at $24,800 that you're now going to subtract On line 15, this is your taxable income. It says subtract line 14 from line 11. Your taxable income is now $30,200. Okay? Let's see what that difference is when we go to our chart. It's showing a $15,000 loss. Your taxable income is $30,200. When you compare that, $30,200, because you have a business, look at the difference in your taxable income. You went from having a $50,200 taxable income to $30,200. You're saving, you've reduced your taxable income by $20,000. Would you rather pay taxes on $50,000 or would you rather pay taxes on $30,000? You know, that's just a real simple question to ask yourself. But if you don't own a business, you can't get that. You can't get that. And this is somebody that started a business and they made only $5,000 and they're showing a $15,000 loss. So now what happens if that person makes $40,000 in their business? Okay? It's crazy what you can do when you have a Schedule C. Same $20,000 expenses, same gross income from their job, except for they made $40,000 in their business. Okay? We're going to use the same form, the Schedule C, the Schedule 1, and now we're also going to have to introduce a new form. Because now instead of a loss in your business, now you made a profit in your business. And the government's going to do something else for you because you made a profit in your business. And we keep saying the government's going to pay you for this. We're not just talking. That's not just talking point. The government does that. Okay, so going back to your 1040 form, using the bottom half again. Okay, using the Schedule C again. Part 1 and Part 2, the income and expenses. Let's show it. Okay, you got the $40,000 on line 7. Okay, that you made in your business. You got the same expenses, $20,000 worth of expenses. Okay, on line 28. Okay, on line 29, it says tentative profit or loss. Subtract line 28 from line 7. And it's kind of funny because you got to subtract this number from this high number up here. Okay, but that gives you a $20,000 profit in your business. Because remember, you still have $20,000 in loss. $20,000 in expenses. So $20,000 expenses leaves you with a $20,000 profit. But you got a profit. Okay? You bring your profit down on line 31. It says net profit or loss, subtract line 30 from 29. You know, there is nothing on line 30, so bring the $20,000 down to line 31. Okay, again, now you got to read again. If a profit, enter both on Schedule 1, line 3. And they try and trip you up when they put things in parentheses. Okay, but it says Schedule 1, line 3. Okay, so you're going to go back there. Let's go to Schedule 1. Take that $20,000, put it on line 3. As I told you, bring it down to line 9 because you're combining your income. We're not showing you anything else but the 20. So there's $20,000 on line 9. Okay, now your adjustments to your income. That same pension plan that you did with the $5,000, now you're going to take $20,000 and put $20,000 in your IRA. Okay, you have that ability to do that. You made that extra money. Now you're going to take advantage of the laws that are out there for you to take advantage of that you may not have known. Okay, going to put that $20,000 in that IRA, bring that down to line 22. And it says there, these are your adjustments to the income. Enter here and on form 1040, line 10A. So we go back to 1040 form and start filling out your 1040. You still make the $75,000 in your wages from your job. Okay, other income from Schedule 1, line 9. You go back to Schedule 1, line 9, and get your $20,000. Put that on your 1040 form. Okay, line 9 says add up 1 through 8. I'm sorry, line 8, 1 through 7, and 8. This is your total income. On line 9, you made $95,000, $20,000 from your business, $70,000 from your job. Okay, then on line 10A, it says go to form Schedule 1, line 22. There's your line 22. This is where you put your adjustment to your income. Remember, you put that adjustment into your IRA. Okay, we're not going to show any charitable contributions, so we're going to bring that total down to line 10C. Okay, it says subtract line 10C from line 9. This is your adjusted gross income. You got a $75,000 adjusted gross income. Okay, don't forget about your standard deduction of $24,800. You got $24,800 there. Qualified business income deduction. Since you made a profit in your business, and you can only use this when you make a profit, they're going to give you an additional $4,000 that you can remove from that, or that you can add to that standard deduction, giving you a total of $28,800 that you can subtract from the $75,000. And now your taxable income is $46,200. Just think about that. You made $40,000 extra in your business. Okay? Let's bring this up on that chart so you can see it again. Okay, you made $75,000 in your wages, $40,000 in gross receipt. Your annual income is now $115,000. You got total expenses of $20,000, but you got a net profit in your business this year. Your taxable income is $46,200. Let's see what happened. Take a look at that. You made $115,000 between your job and your business, but your taxable income is $46,200. Compare that to the $50,000 that you had to pay taxes on, and you did not own a business. That's crazy. I can make $115,000, pay tax on $46,200, or I can make $75,000 and pay taxes on $50,000. That's crazy. Okay, you got a $20,000 savings just by starting a business and making $5,000. And you're going to save even more, or your taxable income is even lower when you make a profit in your business. Okay, you always heard numbers don't lie. And all you got to do is fill it out, what the 1040 says, or don't you fill it out. Take it to JT. Let JT do your taxes. Put this thing right, because he's going to find all those other deductions that you're entitled to. Okay? This is all part of your income shifting membership. Okay? Make sure that you go back there, use your cash flow manager. Find your cash flow manager here. Use your debt elimination calculator. Correct your withholdings. There's a video in your back office that tells you how to do everything that we're talking about. And then keep great tax records. The videos are in your back office and your income shifting membership chart. Okay. There's your tax record keeping, your cash flow manager on the mobile training. You get your mobile training, cash flow manager on your computer training. It's all in your back office. Okay. And this is the video that's in the back office that I just showed you right there. Just go through your back office, see what you have. This is the plan that you have to work all year long. Get the extra money, think about what you're going to do with it, keep good records, and then at the end of the year, you get a chance to use your Schedule C and lay out all those 450 tax deductions that you've incurred. And that's my explanation of the Schedule C. If there's